What's up, Denver? Chris Lopez here. And today we're going to be talking about wealth preservation versus wealth creation. We're often talking on the podcast how to create wealth. And today's podcast, we have some great guests talking about single tenant properties, which is much more of a wealth preservation strategy and asset class. Something I'm very new to, eager to learn about. And I got my co-host and friend Terrence Doyle here today in the studio. Terrence, what's up?
Chris, I'm super happy to be here. It's been a couple weeks since I've been in the studio, so I'm just kind of trying to get my bearings here. I've kind of shaken things up, but it's great to be here. I got two of my newly formed friends in the Denver real estate game. We got Brandon and Zach from Blue West Capital, and a little background to set the stage because I really want them to own the show today. But I was struggling with a deal in Denver. It was formerly an apartment building. Some things happened with the city of Denver. We're not going to go into too much detail there. The long and short of it is I was struggling to sell this building because it was not an apartment building. It was more of like a triple net, single tenant type deal. So I had hired a brokerage to represent me. It did not go well. And I had quite a few dollars tied up into this deal. And so it was starting to like really irritate me. And I saw a LinkedIn post, and this group had sold another property that was similar to mine. And so I immediately sent a text on LinkedIn. Thank you, social media. And I think within 2 weeks, we had a listing agreement. Mm-hmm. And I think like 60 days after that, we had the property closed. And that was how this relationship started with Brandon and Zach. So Brandon and Zach, you guys are very near and dear to my heart because you guys helped me sell a very difficult deal. I will forever be indebted to you guys. And I'm super glad that you guys are here. I can't wait for the audience to hear about your background, what you guys do. Mm-hmm. I think you guys are rising studs in the single tenant game. And so welcome to the show.
Thank you for having us. That's quite the introduction. I guess kudos to LinkedIn for hooking us up. My name is Zach Wright, Brandon Gayeski. We have a company in Denver called Blue West Capital, and we sell single tenant net lease investment properties, as well as some multi-tenant properties, but our focus is primarily single tenant net lease.
So let's start off with that. Like, what exactly is a single tenant net lease property? Because I've heard of it. Mm-hmm. I'm much more in the single family, multifamily world. I have a vague understanding of what that type of property asset class is, but explain it to me in the audience so we're all on the same page.
So a single tenant net lease investment property is a freestanding building that's leased to one tenant. You probably see a lot of them when you're driving around town, whether that's a McDonald's, an O'Reilly Auto Parts, Chick-fil-A, a Walmart. And it's one tenant who occupies the building, and they are on typically a triple net lease, meaning that the tenant is responsible for everything.
So a lot of these, big tenants, big stores, they don't own the property. They're often just leasing it out, is my understanding.
That's correct. So some tenants own their own real estate, or some retailers own their own real estate, but the overwhelming majority are simply just tenants. So when you're driving down the street and you see a 7-Eleven or a Starbucks or a Sherwin-Williams, these properties are owned by passive investors, and they are leased typically on a long-term basis to the tenants. And so it's a very popular asset class right now. And that's what we focus on.
So let's take a step back because we've thrown around some terms here that most of the audience, even myself, am not very familiar with, right? I come from the multifamily, single family world, right? You guys are much more commercial, and you're throwing around terms like triple net, double net, all these, some other things. So unpack, what does triple net actually mean? And to the owner, let's say like myself, someone that owns real estate, what is the net effect? What's the value in having a triple net versus a multifamily building that the owner's paying for the common utilities, the taxes, the insurance? So define triple net, and then let's bring it home to the owners out here. And what does that actually mean?
So the single tenant net lease investment properties are attractive because they are triple net. The 3 N's stand for insurance, taxes, common area maintenance to the building. So the tenant is responsible for all of that. So for an example of a multifamily building, if you have a roof leak, that's the landlord's responsibility. He's getting calls from the tenant. For a single tenant investment property that is truly triple net, if there's a roof leak, the roof needs to be replaced, the parking lot needs to be resealed, that is the responsibility of the tenant, and they are not calling you as the landlord. They handle it directly. It's a very passive investment. We typically see people that are either trading out of multifamily properties, getting older in age, getting tired of the management intensive kind of asset and looking for more passive income for a single tenant property that has a tenant on a long-term lease where there's no landlord responsibilities.
And not all single tenant leases are the same. To your question, there's triple net leases, there's double net leases, and they usually vary as to what the tenant does, what the landlord does, and how that relationship goes. But, on one end of the spectrum, you might have an absolute triple net lease. In many cases, the tenant pays the property taxes directly. They maintain insurance directly. Any maintenance or repairs, replacement needed to the building, the tenant does. So it truly creates a mailbox money type of ownership where you receive a check once a month, and that's the extent of your ownership.
So that's a triple net.
That would be the, yes.
Give us some common examples that we see driving down, Broadway and Colorado.
Good examples of an absolute triple net lease would be like a Walgreens.
Okay.
The tenant receives the property taxes on these leases. They pay it directly. They have the insurance. Most cases, they maintain the building.
Is there any scenario in a triple net lease? Because I'm just thinking this sounds too good to be true, right? We get calls all the time with issues. That's all we hear about is issues, right? And so is there any scenario under a triple net? So I own Walgreens. Is there any scenario where Walgreens corporate is calling me and saying, hey, Terrence, we need you to go fix XYZ?
So there are leases that have some management responsibilities or maintenance responsibilities. Maybe it's to the roof, maybe it's to the parking lot, maybe it's to the HVAC. And in some cases, it depends on what the lease says and what the tenant is. Typically, tenants sign a kind of standardized lease.
Right.
And so pretty much all Walgreens leases will look the same. All Dollar General leases will look the same, for example. So we would call those more of a double net lease where there would be some sort of landlord responsibilities. Maybe it's to the roof if there's a roof replacement needed. Maybe you need to maintain a liability insurance certificate. Things like that might move it from an absolute triple net down the scale to a double net lease. But it's still an extremely passive lease. Typically on a new construction property, you'll have warranties for the roof, warranties for the HVAC. So it kind of mitigates a landlord's financial responsibilities over time.
So
yeah, go ahead.
I just want to make sure I understand. For the double net lease, triple net is maintenance, taxes, insurance. Double net, what are we dropping out of there?
Some maintenance.
There
could be some maintenance that would be a landlord's responsibility to, some critical elements of the building. Maybe it's parking lot.
Okay.
Maybe it's the roof. Maybe, you manage snow removal and landscaping, but that's reimbursed. There's more to it than just, being on a beach and getting a check or, an ACH hitting your account once a month.
So with a true triple net, can I have that lease in place and have no property management company in place?
Absolutely.
Mm-hmm.
Okay. Double net, is that kind of...
I would say a majority of the stuff that we're selling, is new construction sometimes where there are warranties in place. The truly triple net, there's no responsibilities for you. The double net, the tenant still pays the taxes, insurance, and everything. There's just a carve out sometimes where if the roof needs to be replaced or there's an issue with the foundation, that falls on the landlord. But we have clients who are based here in Denver and own these single tenant properties all over the country.
Okay, so I'm starting to understand a little bit of value of just the peace of mind and simplicity and efficiency in owning a building where maybe I only get a call once a year versus once a week, right? So that makes a ton of sense. I see the value. Now, talk to us about how these things are priced. And, because right now, apartments are trading somewhere between, well, it depends, new construction, but somewhere between 5 and 6 caps, right? Most of Denver Metro, somewhere between 5 and 6. Des Moines, Iowa, we're picking things up 6 to 7, sometimes 7.5, right? So, but then we cover everything. Taxes, insurance, and the maintenance. So much more active, like roll up your sleeves, get to work every day. So talk to us, help us understand the value, right? If I'm going to get something that's truly passive, what am I getting in terms of cash flow and a return profile?
So the cap rates are going to be based upon several things. The term of the lease, we have short-term leases that trade at a higher cap rate. We have long-term leases that will trade at lower cap rates. So, generally speaking, these deals will have anywhere from maybe 2 to 25 years of lease term in some cases. So the remaining lease term is a big factor in determining the property's value. Another factor is who's the tenant? What's their creditworthiness? So, our deal types range on a risk spectrum from, the top tier tenants, perhaps it's a 7-Eleven, investment grade rating to maybe a mom and pop type of franchisee operating a Burger King. So, the pricing, the cap rate is based upon the credit. And then of course there's other factors based upon, locations. Denver will trade better than Iowa, for instance. But generally speaking, for the top tier deals, they could be in the low 4s, even sub 4, for a ground lease in California, to a McDonald's, for instance.
So let's talk about some of the top 10, because I think these are brands we all know. So let's talk about some of the top companies in the country. So let's talk about Apple, Amazon, Starbucks, Nike, McDonald's, right? So are those considered, is there anything above that, or are those considered like the top tier? Like if you have them as a tenant, that's as good as it gets?
The top tier tenants would be those with very strong investment grade ratings from Standard & Poor's or Moody's, these tenants or very large private companies like a Chick-fil-A. So typically speaking, the deals that are commanding the greatest premium would be the likes of a Chick-fil-A ground lease, a McDonald's ground lease, a 7-Eleven. These types of very strong credit tenants have the lowest cap rates. But
what are those then? So if McDonald's is going to sign a lease with me and I'm going to own the dirt there, what am I looking at in terms of a cap rate or a return?
3.5 to 4.
3.5%. So let's say easy numbers, $1 million. I put in $1 million and they're going to pay me $35,000 a year for that lease.
Or more. Yes, or more. But on the other end, the cap rates could be anywhere up to probably 7 for deals with, that aren't ground leases or that are in different markets outside of, maybe California or Denver, things like that.
Give me some examples. So if McDonald's and 7-Eleven are 3.5%, 4% cap rates, which just means the return, right? The annualized return. So then talk to me about a 6 or a 7. What am I looking at? Who's the tenant? Paint me a picture of if I'm like, for me to trade out of this apartment complex where I'm getting 6.5% on my money annually, I need to be at, a 7. What am I looking at for a 6 to a 7 in Colorado? What kind of tenant? Talk to me about the location. What does a deal like that look like?
You're probably, one, I guess right now the market is very limited with supply, similar to probably other asset types, maybe multifamily or residential. So right now cap rates are at historic lows for single tenant properties. So in Colorado right now, it being a very attractive place for investors, you're looking at maybe more short-term deals and maybe with 5 to 10 years left. Maybe franchisee type tenants, but dollar stores, lube centers, things like that, you can get in the 6s.
So that makes sense. Like obviously, like the shorter the lease or the length of the lease and the quality of the tenant's going to, demand a higher cap rate because it's riskier. Now I'm trying to figure out like if it's a shorter lease and let's say it's a Jiffy Lube or a Walgreens, I drive by those every single day. I think about, great, I'm going to higher cap rate, but what happens when they move out or once their lease is up? I imagine it's harder to get a tenant into a Jiffy Lube type location than it is to get into one of Terrence's apartment buildings. For like, hey, I got to fill this 2-bedroom, 1-bath. So how do you equate like the tenant placement or future tenant placement in that risk reward ratio? Like what happens when that turns over, you just find another tenant in that same profile?
Yeah, I think, that's a great question. And I think to take one step back.
Yeah.
For example, for a new Starbucks, these deals are trading in a finite range, whether that's, 4.5 to 5 cap for a brand new construction one. If you're an investor who wants to buy a 7 cap Starbucks that's brand new construction, it's just not going to happen. You would have to buy one that had a shorter lease term, for example. And the reason the cap rate is higher is there's more inherent risk that the tenant only has 4 years left on the lease compared to a new construction one that has 10 years where somebody has that guaranteed income.
Can you kind of quantify them? Is that like a point on a cap rate just as a real rough quantitative, or do you not want to?
You're saying
it varies so much.
Okay, there's just so many variables. Okay.
But to your question, the tenants have renewal options. So on most, they might have 20 to 30, even 40 years of renewal options after the initial term of the lease expires. So, finding a Jiffy Lube or a Walgreens with a short-term lease, it's important to start digging in a little bit deeper into the deal. What is the rental rate that they're paying and how is that relative to the rest of the market?
Okay.
and that's kind of looking at the replaceability of that income stream. How is that rent relative to other Walgreens in the state of Colorado and Denver, across the country, et cetera, and understanding, is it, lower than they typically pay, above? And then also you could look into some sales information. Some tenants report their sales, so you have a good idea, this Jiffy Lube's doing phenomenal. And then there's other resources if they don't report sales that we could use. There's a company called Placer.ai, and it tracks cell phone data, and it compares cell phone data and number of visitors to a particular property compared to other Walgreens in the state, other Walgreens in the country. So you kind of get a general sense as to, this is a strong performing store. Why would they leave?
So you're not just underwriting the property, you're also underwriting the business as well.
Absolutely.
That's what just clicked with me on there. Okay, so you're looking at the real estate itself, but also just what's the business model. And I guess you get P&Ls and tax returns from that tenant as well, part of the due diligence, or maybe not?
Yes and no. It depends, but usually not, actually. So usually we're relying upon, looking at market data and understanding that this Walgreens is paying substantially less than other Walgreens in the state, in the city, wherever. And understanding what that rent per foot is that they're paying compared to other properties surrounding it if you need to replace it. And then looking at other metrics, try to get an idea is, this is a strong performing store. They're likely to stay here for the future.
Okay.
And, I think some investors just at the end of the day look at, who's backing the lease and how long is the lease. But I think some of the astute investors are looking long term. Maybe I'm buying it as a Starbucks today, but what is that property going to be in 20 or 30 years if I hold this?
Yeah. What's that look like? Like when you guys are underwriting deals and, helping clients trade up or make their next step in their, real estate plans, like how do you plan out 20 or 30 years and what's that look like in your space?
So I think Zach kind of hit on part of it, but I think a big part of it too is, what are the underlying real estate fundamentals? Is this property on a signalized intersection? Does it have good access? Does it have good visibility? What are the demographics? Is this a growing area of town? If this tenant ever left, if it's mid-block or doesn't have good access, another national might not want to backfill it, compared to if it's, the best corner in town or has, great traffic, it's on a good corner, you could probably easily re-tenant that. So I think looking at the underlying real estate fundamentals, Zach hit on the rent level. If the rent's super high and not replaceable, when the options come up, you don't really have much leverage because you want to keep the tenant there, compared to if you found a single tenant deal that maybe had at or below market rent. Might not be the end of the world if they leave and it's good real estate where it could be a value add play for you, where you're able to actually push the rent in the event they leave.
Okay.
And then, I think digging down into the actual tenant, just because the sign says Burger King, it's probably not corporate. It's likely a franchisee. So going another layer deep to understand, who is this tenant? Do they have 5 units or 100 units? What does their balance sheet look like? How much cash do they have? Are they expanding? I think if you can get the store sales, or the store sales trending upwards, have they increased the last 3 years or they dropped the last 3 years? I think is important too, another layer to help evaluate some of these single tenant deals.
Yeah, this is super fascinating. I mean, such a different asset class than what I'm used to talking about in underwriting. So I've, really enjoyed getting to know you guys. And I think this is a really valuable conversation for the audience. Cause it's, I think growing up in Des Moines, you look at like Walgreens or Applebee's or Chick-fil-A or anything, retail on a major intersection. You never understand that like an investor could own that. Mm-hmm. You just think, oh, well, Apple owns their store, Chick-fil-A owns their store, right. 7-Eleven owns their store. You never understand that, oh no, there's investors that own them and then just have a lease with a publicly traded company. So it's pretty amazing to understand how, things work behind the curtain. So I love this conversation. I think the audience is going to get a lot out of it. Help me understand, COVID. So the last year and a half, 2 years, how has this impacted your industry and this asset class? And I'd love to hear about, who are the people buying this stuff and who are your clients and what do they do and what does that look like? Because I know that the brokers I deal with on the multifamily side, it has to look completely different who they're working with versus groups that you guys are probably talking to on a daily basis.
Okay, so COVID, the single tenant space is remarkably resilient. There's long-term leases in place to very strong tenants. So generally speaking, the space did phenomenal. Cap rates have compressed throughout COVID. There's many retailers that are performing better today than they ever did before. Is it Walmart? Is it Dollar General, Family Dollar, Walgreens? So there's a lot of tenants doing very well. And because of that, the space has performed very well. Of course, there's some single tenants, gyms, movie theaters, some casual dining concepts that were hit very hard by COVID because of their inability to operate. But generally speaking, most tenants in the single tenant space, dollar stores, drugstores, grocery stores, quick service restaurants, all perform very well. And so cap rates have continued to compress. Demand has been very strong. On the buy side of who we're typically working with, it's overwhelmingly 1031 exchangers. And oftentimes these 1031 exchangers are switching asset classes and typically exiting management intensive properties and coming into the single tenant space. So, we work a lot on the buy side with multifamily investors that are looking to alleviate some headaches or set up retirement or estate planning. So that's a very big group of buyers in which we're working with on the 1031.
So out of 10, I think that's a great, I think this is really relevant, obviously, to the audience and, kind of what I do in my core, business is. So out of 10 clients that you have, how many would you say are multifamily owners in the past looking to get into something more passive?
So I'd say if you just took an average sampling of 10 deals, I'd say about 8 of those are being bought by 1031 exchange investors, perhaps even more. On average. And I would say of that, maybe half are exiting multifamily. The others are maybe coming out of shopping centers. Perhaps it's land or farms. It's actually a pretty big chunk, but I'd say about half of the exchangers are switching asset classes and coming out of multifamily. It's funny. I'm actually working with a gentleman that sold a multifamily property in Texas. He's buying $4 stores right now in the Midwest. And owns a number of multifamily properties currently. And, I think he's looking for ease of ownership and perhaps even a lifestyle change and, less hands-on management with his real estate. And we're under contract on these dollar store properties. And we were talking about them yesterday, and he had to run and scramble because the HVAC went out on his multifamily deal. And he's getting all these angry calls from his tenants and, trying to restore the air conditioning and heat, and then figure out, how to compensate these folks. And so at the end of last week, when he was dealing with this, we couldn't really talk about the acquisition because it was all hands on deck, to resolve this issue. And so I think that, it is a big microcosm of what we deal with on the buy side of multifamily investors getting out of management intensive properties, coming to passive properties, long-term leases, high credit tenants, big chunk of our business.
And this is something, and when we first met, a while back now, you really, in my mind, one of the things I took away how you framed it was, a lot of the wealth preservation versus wealth creation. Obviously, with, multifamily residential through leverage, through value add, and the market appreciate, great wealth creation standpoint. But you frame the single tenant role as a great way to not only have cash flow, but really preserve wealth. And you kind of identified, some customer avatars for as people trade up. Can you go into more details on them? Because I found it very fascinating and it kind of gets my brain thinking for, 20 years down the road for myself. So I want to learn more about this. Like, how would you frame that on the wealth preservation versus wealth creation side?
Yeah, I think, a lot of the people who are buying these, made a bunch of money in multifamily.
Yeah.
They're getting older. Maybe they have grandkids. They want to, hit the golf course with parents or something, and they want to retire.
I'm a great golf outing.
Given the limited or zero landlord responsibilities, people are buying these. It's almost a bond market of real estate, or people who, want to be in the real estate business, but either don't have the wherewithal or capacity to manage a property. This is a very attractive, investment for them, where they're getting a property with a 10, 15, 20-year lease to a large company. It has typically fixed rental increases every 5 to 10 years. And they kind of don't have to do anything.
the beauty of it is with the 1031 exchange, right? And the classic multifamily investment of starting, with a fourplex and trading up into an 8 and then a 12 and maybe a 20 and so on up the ladder. And, through 1031 exchanges. And eventually you get to a point where, maybe you're looking for a lifestyle change, or there's estate planning or retirement planning, and you want something passive and easy and headache free, then you come see us. And so, you 1031 exchange and oftentimes, the cash flow goes up and the management goes down, and, exposure to expenses, down the road is virtually eliminated as well.
Can we do a quick case study? Yeah, I think I want to paint a picture, because when I've seen some of the numbers, because I have some mutual friends here, and this is all they do. And when I hear about like the free cash flow, that's like truly passive, the numbers get pretty interesting. So maybe can we do a case study on the gentleman selling a 20 unit? What does like the NOI look like on the apartment building? And with the understanding that that's like a full-time job, it's very hands-on, to like the Dollar Generals. What does that look like passive? Like just a quick, high level numbers.
Yeah. So don't hold me to it, because I'm not exactly sure on the exit, but I think he's selling it like at 5% or lower on
cap rate.
Actual numbers.
On actual, yeah.
And he's trading into a portfolio in the mid 7s. So his cash flow is going to go up considerably. And there's about 6-7 years of lease term on these deals. And so you have that stability, and they're, well-located properties in major markets.
Right.
So his cash flow is going to go up considerably, and his headaches are going to go down.
So he's trading out of a 5 cap. He's selling something at a 5 cap where he's covering all the insurance, all the taxes, all the maintenance, and dealing with all the headaches, right? So it sounds like he's pretty hands-on management style if he's getting a phone call from the AC breakdown. Brutal place to be. I've been there. Not fun. So he's getting out of that and buying a 7 cap of Dollar Generals.
7.5 cap.
7.5 cap. I don't understand why I didn't see this deal.
A family.
We'll talk about that later. Okay.
Don't worry about these.
Anyways, so Dollar Generals, so is that
Family
a double
Dollars
net?
and Dollar Trees. They're double nets.
Double net. So he is going to have some maintenance, but it's not going to be as intense.
Correct.
But they're covering the insurance and the taxes.
Correct.
So,
and most of the maintenance to the buildings.
Most of the maintenance. So maybe he has parking lot, foundation, something
HVAC,
like that.
There's caps on repairs. So I think it's like if the parking lots needs over $5,000, then he, covers the.
So he's getting a 250 basis point premium on what he's selling his multifamily asset at to what he's going to get in return. And what
unlevered too.
Yeah. Unlevered.
Because
but
with leverage, it's
right.
He's hitting double digits.
Yeah.
Yes.
So talk to us. One of the things I'd be interested to understand is, so in multifamily, typically we're seeing between 70 and 75% leverage of total cost, right? So we're buying a building. There's some renovations.
How much did you say?
70 to 75 of total cost. We're somewhere in the range of like 3.5%, 5-year fixed, 30-year AM. That's down the ballpark, down the middle of the fairway. So what are you seeing from banks that are underwriting like a Dollar General, right? That's a 7.5. What kind of leverage and what do the terms look like? Just to compare for multifamily.
So the fixed term of the loan will kind of be dependent upon the term of the lease. They like to be, somewhat coterminous.
Mm-hmm.
So
a 7-year. So if I have a Dollar General that has 7 years left, they're gonna a bank.
You're probably looking at 5 or
fixed.
7 year loan.
Fixed.
But what about like a 20-year lease? Like
so on a 20-year lease, you're getting 10-year money.
Okay.
But on the LTV, assuming it's a creditworthy tenant, you're looking at 70-75%.
Okay.
Oh wow.
You're looking at rates in the today on November 16th are we? You're looking at rates in the high 3s, low 4s, very very low 4s. And perhaps even lower than, high 3s, depending upon the tenant type and the deal.
So still pretty aggressive.
Pretty comparable,
Yeah,
it sounds like.
Yeah,
Yes.
maybe a little bit higher. So yeah, I mean, that seems like a great trade. If you can sell an apartment building where you're hands-on and the apartment's outdated and then get into a 7.5 cap. So talk about the risk then, because it sounds like there's a ton of upside there. The risk is that Dollar General in 7 years will not renew and then he has to fill that building. Is that the downside then?
That's the risk in the deal, and understanding that risk and mitigating that risk, by some of the things that we had talked about earlier.
Understanding the location.
Yeah, understanding the location, trying to get an idea and sense as to how this store is performing, Typically, we like to tell people if you're doing a property visit and you talk to the store manager, usually you get a good idea as to what's going on in terms of that store's performance. So, trying to best understand how that store is doing and how it fits in the long-term plans for the tenant is the key in minimizing that risk. Super
interesting. So with where you guys,
of course,
sit,
also sorry to cut you off. Yeah. With 4, you're kind of a little bit diversified, right? If one of them goes out, you still have the 3, and then you're only re-tenanting one property.
Right. Yeah.
Is that how often people look at it as like they've like, because with multifamily, one of the pros there is, hey, I've got 10 units. If 1 or 2 go vacant, I still got 8 paying rent. Is that kind of mentality for all like single tenant investors? Hey, if I buy 4, okay.
Not really, because generally speaking, you're looking at a long-term lease to a strong tenant, and it's something you could pretty much bank on, that every month you're getting that check for the, foreseeable future. It's not necessarily something to think about once you own the property. You want to do your due diligence up front going in to make sure, does this tenant have the wherewithal to pay, my rent? Is, maybe it's a franchisee and maybe they're loaded with debt and, maybe they're in a business that's, struggling right now. Maybe it's a casual dining restaurant, then that's maybe something you'd want to consider. But generally speaking, when we're helping clients get into these deals, the idea is that you're getting this money every month and it's a steady and stable deal for you, into the future.
You guys are working on some big deals with some big name brands and some big clients. What have you guys seen, the last couple of years, and what trends do you see happening in Denver and Colorado? I mean, do you see Denver with all the money being poured into by these companies? I mean, what kind of trajectory do you put on if you guys were going to, say, hey, if I had a pile of cash, like where would I be putting it? Like, what do you guys see in terms of like the activity on a national level, Denver compared to the rest of the country?
Mm-hmm. I mean, through COVID, I think it kind of accelerated some business models that, weren't going to be here long term. Instead of 3 to 5 years, COVID accelerated it to 3 to 5 months, whether that's JCPenney's or, sporting goods. So, over the last year, we've seen there's kind of a flight to quality. Investors are chasing properties that are deemed essential, that were open during COVID and have been paying rent. So majority of the deals that we're seeing, or at least deals that have had the largest cap rate compression or what investors are wanting, are properties that were deemed essential and did well during the pandemic. Those types of properties are convenience stores, drug stores, dollar stores, auto parts, grocery stores.
Fast food restaurants.
Yeah, and people are willing to pay up for those. On the flip side, if you own AMC or a gym, there's probably a buyer out there, but you're going to have to discount it because there's some uncertainty and risk long-term about kind of where those play in the world. And at least here in Colorado, the tenants that are expanding the most, the gas stations are really expanding. If you drive around Denver, I mean, there's a new one popping up every corner. Mm-hmm. Majority of the fast food restaurants are expanding, and
some
I think
banks and credit unions.
Yeah, I think it's interesting too on the fast food.
They're expanding too.
Some are
in
this market, and
that totally surprises me.
I know I kind of just hijacked it.
I'm sorry. That just totally threw a curveball to like what I was thinking.
Well, and Terrence also mentioned, maybe Colorado or Denver versus other markets, and because the demographics are so strong, because the growth is here, because some people have, second homes in the mountains. Colorado is a very attractive place on a national level for net lease investors to come. So deals in Colorado are trading at premiums to that of the rest of the country. In fact, we're probably trading at as big of a premium as any state outside of California. Arguably. Wow. Because
hold on. So say that again.
Properties in Colorado are trading at as big of a premium as perhaps any state besides California.
Wow.
And that's like Colorado or just like Denver and the Springs?
Both.
Wow. Okay.
Because the vast majority of the properties are located in the Denver metro in Colorado, but the rising tide is lifting all ships.
Yes.
And if you can, write off your trip to your home in Beaver Creek because you stopped by your O'Reilly Auto Parts in Colorado. So
win-win.
So be it. Yeah.
Fuel up the jet. Let's go. Let's go check on it.
Right. So yeah.
So this has been really great. Chris and I were talking, this is not something that we're really well versed in. So I could sit here and talk for another couple hours and just learn and eat it all up. I think this might be a mini series.
We might run a high noons if we do that.
We need more high noons.
We'll get better supply next time.
But maybe what I'd love to hear about is maybe kind of why you're so passionate about this space. From both of you, and maybe what you think your superpower is. Like, what makes you the best, and why should people call Blue West to represent them when they're looking for a single tenant deal?
Okay. Well, I guess first, my superpower. That's a good question. I would say I feel like I know the market extremely well. I grew up here in Westminster, which for the audience is about 20 minutes north of Denver. When I got in the business, I used to take a different route home every day from work, just trying to understand. It's a little different than multifamily. At least on the single tenant front, you want to know what's going on every intersection.
Right.
I'm always looking at, what comps have sold. Feel like I have a good memory, who owned this property, why did it sell, who bought it, what tenants are expanding, track the active development maps. It's big for us to know what areas are growing, where users are going, where's the nearest 7-Eleven or come and go Walgreens. So we track that information pretty well. And I feel like we have a really good pulse on the market, knowing where all the tenants are expanding. And we have some clients who call us and say, hey, I know Quick Trip's coming in here to town, which is a new gas station. Where's every location they're going in the state? And we know that information. So I think just having a good pulse on the market and I guess would be the superpower.
I think speaking for Brandon and certainly for myself and the rest of the company, I don't know if there's a superpower, but I'd say we're very detail oriented and very hardworking. And I think those two combination and client focus and client first. So I think though that combination of the three helps us get the best results for our clients. If we're representing, someone on the sell side or representing on the buy side, I think those qualities, help get you to where you want to be. So I think that kind of answers the why Blue West and superpower.
I think I'd also add, for Blue West, we're just a boutique brokerage firm here in town. We all work together. Some of the national shops, nothing, against them, but you might just have one person working on the deal. For example, Zach and I sit next to each other. We're in each other's office all day. He knows about my deals. We have team meetings. The whole company knows about your deals. So there's kind of more of a team environment, and we're all, working together for the common goal. And I would also say, we just shoot our clients straight. I had a conversation with a guy the other day, owned a trophy Chick-fil-A here in Colorado. I told him there's no reason for you to sell this. What are you going to trade into that's a better property than this long term? So I think, in the short term, being straightforward and honest, might not get you as many deals, but it's how you build the relationships and kind of lays the foundation. Because this is, a long game.
We got many years to go. Yeah. We're young. So we're playing the long game.
So as you were talking, Brandon, one question popped in my mind, because I know for apartment buildings, all that, just they trade off market, majority of them trade off market. When it comes to single tenant deals, do they mostly trade off market? Or are they?
Great question.
Yeah, I just have no idea. How do they trade? How do you find out about them? How do clients, investors get access to them?
Right now, there's very few available deals out there. And when we're hired to sell a property, assuming, it's a good property, we are getting double-digit offers on these deals. And
I guess when he says a good property, that's a new construction, investment grade tenant, long-term lease.
Or it's not priced overly aggressively.
So a realistic seller.
We've priced this. We like to price things aggressively, but it's priced aggressive, but not too aggressive where, we just look stupid with a deal that's overpriced by 200 basis points.
Yeah.
But the market right now, there's such demand for this product right now, and the supply is fairly limited, certainly not enough to support the demand. And so it's very common on our deals, particularly those in Colorado, that we're having 20 plus offers to choose from on the sell side. So because the market right now is so dynamic, it is so competitive, a lot of deals are being done off market where developers may provide us, their pipeline, or we may have some, connections with REITs or private family offices that, I don't want to go through the charade of marketing this right now, but bring me a buyer. and I'd sell. So we're doing a lot of deals. I'd say maybe almost right now, almost half of the deals that we're doing are originating off market, where we have access to an inventory of available properties through our connections, across the country and in Colorado with various developers, REITs, funds, or private investors. And we're able to, put deals together through that way. So hit us up.
Yeah. And I just want the other side of the coin is the public market, is that is that LoopNet or what's the equivalent? Because I know multifamily, LoopNet's more the public.
There's LoopNet, but it seems the most prevalent one right now is Crexy.
Okay.
Where people are finding the single tenant deals.
That's for a lot of, okay.
But by the time, if there's a good deal out there.
Oh, it's gone, right?
There's, 4 or 5 offers on that deal right away. So unless you're, the first to see it and track in daily, that deal might be spoken for by the time you see it.
And I think I would also add, he said, there's a lack of supply of quality deals out there. Part of the reason that is during COVID, a lot of these national tenants, Starbucks, O'Reilly Auto Parts, 7-Eleven, there was so much uncertainty on what the world was going to look like, where, current deals they had in the pipeline that they're working through the development process, they either put on hold or just terminated. So there's a lag in the current supply, given a lot of deals got terminated last year. And now tenants are kind of back in the saddle looking to do new deals. And that's just kind of why there's a lack of supply out there. So if you do have a brand new construction 7-Eleven or Sherwin-Williams or Starbucks, I mean, there's a lot of people looking for those properties right now.
Guys, this has been great. We'll definitely do, I think, as Terrence said, a mini series into a deep dive. I've got a list of questions that will not make it through in this podcast that we'll save for later. But what I've enjoyed getting to know you guys, throughout the year, and I love just the expertise. You guys are, just hyper focused, but also just the collaboration you do with like the other asset classes of the owners. Like, hey, you actively collaborate with the agent and the buyer selling their single family portfolio, their multifamily. I think that collaboration
Absolutely
is so essential to make sure that, hey, the left hand, the right hand knows what it's doing. So I love that about you guys and your model here at Blue West Capital. So as you wrap up here, what's a great way for people to get a hold of you, to learn more about it, to run a deal by it, to explore options? Like, how do they get a hold of you two guys?
www.bluewestcapital.com.
I love it. And we'll put the show notes in there.
Yeah.
LinkedIn or whatever.
We'll have
you
our
guys.
contact
Yeah,
info
we'll put
on
that in
the-
the show notes.
We have LinkedIn. You can go to our team page, all of our contact.
But what's the
info's
one
there.
best spot? Just reach out on the website or LinkedIn or
Email, probably.
Okay.
Email or
call my cell phone.
Okay.
Put
Cool.
the cell on there, Chris.
All right.
I'm available.
All right, we'll do that. So text you at 2 a.m., right?
There you go.
Right? That's the best time. Guys, this has been phenomenal. Thank you so much. I've enjoyed learning about this. I feel like we just scratched the surface, so thank you.
Thank you for having us.
I appreciate you guys having us.
You guys crushed it. Nice work.